I was looking at the 200-day moving average for both spot gold and spot silver. However, technically, I've also seen a turn. So yes, I think we will see the spot markets go up pretty substantially. Remember, President Trump is a change agent. When he came in, what they need is a large enough crisis to scare people enough to accept whatever it is that they want to push down our throats. Whether it's stable coins or CBDCs, this is taking us into a full surveillance economy. Once the public has its power back, we can make sound money shine because we will have control over these politicians and over these central bankers. It must be redeemable gold, and we can do it even in an electronic system. That's not a problem. This is about our freedom. Physical gold, physical silver buys your freedom. Why do you think the governments and the central banks are loading up on it?
Good evening, Lynette. If you obtain minimally 200 ounces of silver, how many ounces of gold should you obtain for a family of 5?
Well, everything is based upon your current circumstances and your goals, right? And then what you're trying to accomplish. So what we do, there is no pat answer for that because I don't really look at the ratio of gold to silver. That's not how I built my personal portfolio. What I did was, and what we do is we set up your goals. What are you trying to accomplish? If you have a family of 5, then, and let's say there's a 2-parent household. So then I would say, okay, so you have 3 children. Are you looking to educate them in the future so that we need to prepare to pay for college tuition and the cost of that education? Are you looking to set up for retirement? So it's always the right tool for the job. And Kenneth can tell you that we do have a spreadsheet that's set up that says, okay, this is better. If you're going to go to the store and get some strawberries, then you want silver. If you're going to pay your property taxes, then you want gold. So we can determine based on what you're trying to accomplish what that gold to silver mix should be. But that can vary from person to person. So it really does depend on your goals. Do you want to add something to that?
Most investors chase ratios, but the real decision here is about cash flow under stress, not asset allocation theory. As Lynette Zang points out here, the gold versus silver split isn't a formula. It's a reflection of future liabilities like education and taxes. That's critical because inflation-adjusted college costs in the US have risen over 150% since 2000, meaning your plan must match real expenses, not market narratives. The idea of matching metals to spending types quietly exposes a gap most portfolios ignore: liquidity timing. Next, Lynette Zang discusses how flexibility inside a strategy becomes more valuable than the assets themselves.
It really is based on each it's a customized strategy. So it's each individual basis. We look at this from a bird's eye view for every client that we deal with at Zang International. And we say, okay, what is going to be the best plan of action for your specific situation? And for, like, to your point, if you need to get strawberries from the grocery store, that's a much different thing than having a medical bill that you need to pay, or
Exactly.
if your vehicle needs to be replaced. Things that come up, we account for everything. And the other amazing part about it too is we have diversification within each asset in the strategy. So what if you only need a couple silver dimes to go and get what you need to get versus taking a whole ounce of silver or an ounce of gold? So you've got options, and options buy you freedom. And that's really what the strategy is all about: getting your freedom back in your control, in your possession.
Yep. And, if we really want to expand that, I mean, a big reason why I'm traveling around the world and handing out these dime cards and doing these events to talk about sound money is to build that global community And, we can have this very peaceful and quiet revolution just by converting your garbage fiat that, you can all see how it's being inflated away. Its value is being inflated away these days. And actually, since the day you were born. And we can account and set things up that will put you in the most likely best position to take advantage of the opportunities. But we also want to make sure that whatever it is that you're trying to accomplish, I've heard you say this, and it's very true. Our goal is to meet you where you are and help you get to where you want to be.
Absolutely. Yeah. It's all about just finding that goal and using that strategy as the bridge to get you across the gap.
Right. I did look, because this is something that people always ask. Anyway, I did look at that silver to gold ratio. And this morning it says that it's 63 ounces of silver to 1 ounce of gold. I don't look at either gold or silver as a trade. I look at it as a strategy. And based upon what history tells me, that's the direction that I like to go in. So really good point, because there's gold, and then there's gold, and there's silver, and then there's silver.
Customization sounds reassuring, but it also hides how fragile most financial plans are when liquidity disappears. As Lynette Zang points out here, breaking assets into smaller usable units, like silver dimes, addresses a real-world problem. Markets ignore transaction practicality during stress. The 63 to 1 silver to gold ratio may look like a signal, but historically it swings wildly, meaning timing it becomes speculation, not strategy. What's often left unsaid is that freedom here depends on access, not just ownership, something 2008 and 2020 both exposed. Next, Lynette Zang unravels why market signals may be turning despite broader financial weakness.
And then we have Linda L555. I think gold and silver will go up very soon, right?
If you're looking at the spot markets, yes. I was looking at the charts earlier before we came on air, and there is a turn. So yeah, if you're thinking about buying a bullion-like product, it doesn't have the same kind of impact on the lower population, more rare coins as it does on the higher population or those raw coins. So yes, it definitely looks like it has turned. But keep in mind that it's still, and you might not have been on because we had a little trouble at the beginning of this, but I was looking at the 200-day moving average for both spot gold and spot silver. And for spot gold, it is now roughly 13% above its 200-day moving average, which, remember, technically 10% is a lot, right? But on silver, it's about 30% above its 200-day moving average. However, technically, I've also seen a turn. So yes, I think we will see the spot markets go up pretty substantially. This is especially when I looked at everything else other than oil, but the stock markets as well as the crypto markets are significantly below their 200-day moving average. So that is definitely bearish. Negative is what bearish means. Whereas with spot gold and spot silver, they still remain in a very bullish trend.
Right. Yeah. In spite of everything that we see happening because of, uncertainty in the global geopolitical stage and the fuel prices, really, I find it just so, I guess, eye-opening that a rise in fuel prices could be what makes or breaks somebody that is just out there, working day to day, living. But even with all that, and even with that, technical pullback that we saw on the spot contract price of gold and silver, they're still resilient. They're still above that moving average. So it shows, that's what the whole purpose of the real sound money is. It's to combat everything that happens inside the traditional system.
When gold is up 13% above its 200-day average and silver is pushing 30%, that's not just momentum. It's a divergent signal. As Lynette Zang points out here, while metals stay elevated, equities and crypto slipping below their 200-day averages suggest liquidity is tightening beneath the surface. That contradiction matters because historically, when safe havens outperform risk assets, it often precedes broader market stress, not recovery. The quiet part here is resilience isn't strength. It's capital rotating defensively. Next, Lynette Zang talks about how this trend connects to deeper systemic shifts beyond just price charts.
Chad FB, how do they get to break the system globally to usher in the CBDC? And how do they fail so metals can shine again?
Well, I think we're experiencing that right now. Remember, President Trump is a change agent. When he came in, what they need is a large enough crisis to scare people enough to accept whatever it is that they want to push down our throats, whether it's stable coins or CBDCs. This is taking us into a full surveillance economy. And if you look at what's happening right now, even if they came to an end of the war today, the damage to the infrastructure, the energy infrastructure, and the cost of that energy, that is not going to end as soon as this war ends. So I believe we are already experiencing it. And yeah, I mean, when people can't feed their families, but this is also the best opportunity that I've ever seen to get sound money back in the system. And that's why it's so critically important. And that's why I'm around, distributing the dime cards. So if you're in New Zealand, the next stop is the Bay of Isles. We go there tomorrow. But if you see me, come up to me. If I have a dime card left, I'll give it to you because I've been generous with them.
Crisis isn't accidental in financial systems. It's often the mechanism that forces acceptance of new rules. As Lynette Zang points out here, the push towards CBDCs aligns with periods of instability where public resistance weakens under pressure, a pattern seen during 2008 bailouts and 2020 stimulus expansions. What's not openly discussed is how energy costs and infrastructure damage create persistent inflation, locking households into dependency cycles. That environment reshapes spending, savings, and ultimately control. Next, Lynette Zang discusses why public participation could determine whether this shift consolidates power or redistributes it.
We've got to get the word out. And you guys are the army. You're the ones that are really going to do it because there's only so much that I can do. So keep in mind, if you're a client, you get the first one free and however many of them you want at our cost. Let's get the sound money in place. And then once the public has its power back, we can make sound money shine because we will have control over these politicians and over these central bankers. It must be redeemable gold. And we can do it even in an electronic system. That's not a problem. It just must be redeemable, not just asset backed, as I think people are kind of noticing in the private equity market. I haven't even really seen too much about what's going on with that. But before I left, there was certainly a lot that was going on and how many times that same asset had been used as pledged as collateral. Must be redeemable, must be. If it's not redeemable, it's not real.
Yeah, very true. And to bring in that point of how they can justify taking us off of the current system of currency to move us into the new system of currency.
Redeemable is the word that quietly exposes a major flaw in modern financial engineering. As Lynette Zang points out here, asset-backed systems often rely on layered claims, where the same collateral is reused multiple times, a practice widely seen in private equity and shadow banking. That creates a hidden leverage risk similar to what triggered the 2008 collapse when underlying assets couldn't support claims. Investors rarely question whether their exposure is truly redeemable or just accounted for on paper. Next, Lynette Zang unravels how historical currency shifts reveal patterns most people overlook.
I mean, if you look back at the history of major financial changes on a global scale, and was everything kind of preceded by a global conflict?
Oh, 100% of the time. You know, there are things that happen 100% of the time around all of these changes because it is about distraction, right? I mean, they actually even said this in the beginning of this. If we can make people work harder to sustain their standard of living, they won't be paying attention to what we're doing. If we can distract you with war, with inflation, which is that piece making you work harder to feed your family, there's civil rights movements, there's all of the elements that go into a currency transition. They're in play, and they've been in play for a while. It's just that they get bigger and bigger and bigger until it overwhelms the system. So yeah, this is a big crisis, and I think that we're already there. I'm sorry, but we are. However, it's also an opportunity. Get your sound money strategy in place and execute it, and do it as quickly as you can, because it should be clear that we are running out of time.
History doesn't repeat randomly. Financial resets tend to follow pressure points that force public compliance. As Lynette Zang points out here, major currency shifts are rarely isolated events. They cluster around war, inflation spikes, and social unrest that stretch household budgets to the breaking point. What often goes unsaid is that rising cost of living data, like CPI surging above 8% in 2022, creates exactly the distraction needed to push structural changes quietly. Investors should question whether today's volatility is noise or a coordinated transition phase. Next, Lynette Zang discusses why timing matters less than positioning ahead of these systemic shifts.
And while I can't tell you that this is going to happen at Tuesday morning at 9:30, personally, I'd rather be 10 years too early than even 1 second too late. Because really, Kenneth, you made a very significant point earlier, which is this is about our freedom. Physical gold, physical silver buys your freedom. Why do you think the governments and the central banks are loading up on it?
Right. Yeah, exactly. This is something that I think people will realize only when it's too late, that this is what the end of a currency's life cycle looks like, which is why the work we do is so important, because we're just looking at what happens every single time the currency gets to the end of its life cycle, and we see it's a predictable pattern. So, right, why wouldn't you want to have a seat at the table if we know the pattern?
Right. It's exactly right. I mean, what happens if we don't do it? Full surveillance.
Yep.
That's why coming together in a local community is also critically important to create that surety, because there are far too many people that are going hungry.
Being early feels uncomfortable, but being late in a currency shift is where real wealth destruction happens. As Lynette Zang points out here, central banks accumulating gold isn't speculation. It's a signal, with global reserves hitting multi-decade highs in recent years. The overlooked reality is that governments hedge long before public narratives change, leaving retail investors reacting instead of preparing. This freedom framing translates into control over purchasing power when fiat systems weaken. For investors, the risk isn't missing upside, it's losing optionality. Next, Lynette Zang talks about how basic necessities reshape financial priorities during these transitions.
Food, water, I think everybody has seen this, energy, and I think they've seen the water and the food part as well. I mean, can we see the reason why I created the mantra is because this is what we need to sustain a standard of living. Food, water, energy, security, barterability, wealth preservation, community, and shelter. Get it done. Just get it done. And then you're in the much better position. And imagine if 3%, just 3% of the global population owns physical gold and silver. I think, I mean, I could be wrong. I could be Don Quixote, tilting at windmills, but I want a better future for my grandchildren and their children and their children's children, on and on and on. This isn't just about me because, hey, I'm old. I have enough. I have enough for my family too, but I don't have enough for the whole world. So I need some help with that. And why not maintain your independence? Why not leave this world a better place for our children than we found it?
When financial conversations shift from assets to survival categories, that's a signal the macro backdrop is changing fast. As Lynette Zang points out here, prioritizing food, energy, and shelter reframes investing from growth to resilience, a shift seen during every major inflation cycle. The claim that only 3% hold physical metals hints at a supply-demand imbalance that could amplify volatility if adoption rises suddenly. What's rarely discussed is how portfolios built purely on equities struggle when essentials dominate spending. Investors need to think beyond returns towards sustainability. Next, Lynette Zang unravels why strategy matters more than timing ratios in uncertain markets.
Because if we don't get it back in the system, I don't like what I see ahead of us. Do you?
What ratio are you looking to trade silver to gold if it gets there?
Honest to goodness, I am not looking at the gold to silver ratio because for me, that is not a trade. Gold and silver are an insurance policy and a strategy to put me in a position to take advantage of what I can't do anything about, right? It is the end of this currency's life cycle. And so again, I started with my goals. What am I trying to accomplish? And then for myself and my two daughters, I have 10 years worth of silver for my barterable position and also have a bunch of barterable gold in there. So for both gold and silver, I have my barterable positions based upon what I'm trying to accomplish during that first period of time. Whether it's I won't need to buy strawberries because I'm growing them.
The idea of metals as insurance changes how you measure success. This isn't about beating the market, it's about surviving it. As Lynette Zang points out here, ignoring the gold-silver ratio removes the temptation to trade and reframes metals as a hedge against systemic breakdowns. Historically, during currency stress periods like the 1970s, preservation outperformed speculation for long-term holders. The hidden takeaway is that building a 10-year buffer in tangible assets addresses uncertainty that traditional portfolios can't hedge. For investors, this is about resilience, not returns. Next, Lynette Zang discusses how real-world spending shapes asset usage decisions.
But I would still need to put gas in my car, right? So I'm going to use silver for that, but I'm also going to need to be able to always pay my property taxes, and I need barterable gold for that. So I don't really care, and I will not be trading my silver for gold. I will be holding it and using it as I need to until I'm convinced, and I'll tell you what's going to convince me that the system has finished the transition, and that will be when there is truly redeemable gold back in the monetary system again. If we demand it, they will have to do it. They will not do it voluntarily, because why in the world would a government or a central bank want to give up their money monopoly? We did it in 33. That's insane to me, but I can understand how it happened, right? We need to take our power back. So no, I don't really care about the gold and silver ratio, and I'm not going to trade silver for gold when it hits there, because I'm executing a strategy based upon history.
Right. Yeah, absolutely. Yeah, the playing the ratio is more a trade. And I mean, if you get in at a good time on that ratio, that's luck, right? You can't time those
Yeah.
things perfectly, and you don't want to leave a strategy up to luck.
Right.
It's just it makes much more sense from our perspective to have your strategy put in place so you know exactly how much silver, how much gold, and then from there, look, anything else that you want to add on to that position, it's just extra cream that rises to the top.
Most investors think in trades, but this mindset exposes why timing strategies often fail under systemic pressure. As Lynette Zang points out here, separating metals by function, silver for daily use, gold for larger obligations, reflects real-world liquidity needs that markets rarely price in. The overlooked risk is relying on luck in timing ratios, especially when policy shifts or currency controls can override market signals overnight. History, like the 1933 gold confiscation, shows governments act decisively when control is threatened. Investors should question what they actually own versus what they can access.